Today, we are going to talk about a simple yet pretty powerful investment strategy. It's called dollar cost averaging, DCA for short. Sounds cooler that way, right? Yes, it is a cool, fancy sounding term that you may have heard of before, but never really knew what it meant until today when you're listening and watching this. I'm Andrea Heng, and today on the Money Talks podcast, I'm going to get some advice on DCA investing, who it's for, what's it for, when's it for. Sitting in the hot seat to help me with that is Isaac Lim. He is Chief Market Strategist at Moomoo. Hi, Isaac.
Hi, Andrea. Thank you for having me here
I'm
today.
really excited to get into this conversation with you.
So am I.
Yeah, because I've heard about this all the time. And you know how there are YouTube videos, social media videos that tell you, oh, I do DCA. Like it's some cool thing that I'm left out of. So I'm a bit FOMO right now. But before we get into the ins and outs of DCA investing, maybe you could just tell us in very simple terms, maybe explain it to a 15-year-old what dollar cost averaging is.
So that's a very good question to start off with. To put it very simply, dollar cost averaging is taking the spare money that you have, and then investing it into, say, a specific stock, or let's keep things general and broad, say into the STI, for example,
Sure.
the STI index, right? You invest in it in equal amounts at periodic moments in time.
Okay.
Right? So basically, dollar cost averaging is being disciplined with your investing and trying to bring the total cost of your investment and averaging it lower.
Okay. So when you say over a period of time, typically is that a monthly thing or a weekly thing? How does it go?
Well, I mean, it definitely boils down to the individual,
Right.
What is your investment horizon,
Okay.
right? So let's keep it general again. Let's say your investment is, say, maybe over the next 5 to 10 years. Right, then of course, to dollar cost average, investing into the STI, what you want to do is maybe, depending on your comfort level, do you want to do it monthly? Do you want to do it, say, maybe every quarter? Or maybe if you are the kind of person that lives, week to week. I do have friends who are freelancers and their projects don't come in very often, so they actually break down their expenditure into a week-on-week basis.
Right.
So what they can do is actually set aside a small amount of money every week and then just invest it into the markets.
Right. It's kind of like thinking of it as a bill to pay, an expenditure, basically, right?
Correct.
Okay, a
yeah.
regular expenditure.
A regular expenditure, or you can think of it as like a regular savings plan.
Okay.
Yeah, but of course with a very much longer term horizon, right? So like 5 to 10 years, that kind of thing. Yeah.
I don't mean to be pedantic about the rules, but does it have to be the same amount every week or month or quarter?
Of course, there's some flexibility to it, but dollar cost averaging, the whole idea is to set aside a set amount of money. It's the whole idea of being disciplined with your investments, and then over time, in a periodic, as I mentioned, in a periodic manner, put it into, say, an index fund, or bond fund, that kind of thing.
Okay.
Right? Yeah.
All right. So for those of us who are new to investing, could you maybe walk us through how dollar cost averaging works? So say we are putting in $500 every month. What's happening to that $500 at every month that I put it in? What's happening behind the scenes?
So just as an example,
Sure.
let's say we are going to buy a stock. We want the dollar cost average into a stock. So today this stock is, say, maybe $100.
Okay.
So at $100 today, the start of the month, you buy $500 worth of it.
Sure.
Right, and then maybe the next month, the stock has fallen. Right, so it goes down to maybe $80.
Right.
So you buy another $500 worth of this stock at $80.
Okay.
So it will actually start bringing down the overall cost. So you have already invested, say, a total of $1,000 over 2 months, right? But the average cost that you are buying this stock is not at 100, neither is it at 80. You're hitting very nicely in the middle, say maybe about $90, that kind of thing.
Okay.
So, you can actually go to your friend, when your friends say, hey, I got this hot stock at like $100. You're like, because of my dollar cost averaging strategy, I got in at 90.
Right.
Yeah, so it seems cool that way, right?
Right,
It
a bit
seems
of a
cool
bragging right
Correct,
kind of thing.
yeah,
Okay,
correct.
interesting. I
Yeah.
see
I mean,
that now.
as Singaporeans, who doesn't love a good bargain, right?
You're right. You're absolutely right there. So on that note then, what kinds of stocks or stock buys tend to, or instruments or financial products tend to be better suited for dollar cost averaging approaches?
I think that's a very good question, Andrea, but I want to pull us back a bit more.
Sure.
I think before we dive into what kind of asset classes, stock buys or index, that kind of thing, I think let's take a look at first and foremost, the psyche of an investor who does dollar cost average.
Please.
This person generally tends to be more risk averse, first and foremost. Secondly, this person will think that he or she has a bit more discipline in their investment journey.
Right.
So I would agree that definitely dollar cost averaging builds a person's discipline in investing. And I think that is very important because, as we all know, markets go up, markets go down. Today you're up 5%, tomorrow you're down 30%, like the April Liberation Day sell-off.
Oh,
right?
yes. Remember that, yes.
So having discipline goes a long way in this investment journey. But dollar cost averaging, why I say is really for the risk averse people. It's more because you are actually averaging the cost lower. So if the price of whatever asset class that you're buying in is dropping, on the surface you'll think that now would be a good time to average into the market, into the asset class, right? So whatever asset class it may be, now would be a good time. So immediately your thinking is being reframed, right? But for these people, you will not be looking at your investment and say, I spent 500 the last month, and then now I'm spending another 500 again, and then now because of market sell-off, my investments are losing money. Now I'm going to put another $500 again. So if you were to think deeper, right, you're actually averaging down into an asset class that is falling in value, right? So this falls under the realm or the scope of behavioral economics.
Yes.
And it is actually very much authored by Daniel Kahneman, one of the Nobel Prize winning economics professors. He actually wrote on this theory called the prospect theory, which is, in short, loss aversion bias.
Okay.
Right. And this is something that is actually, I would say, very unique to Singaporeans.
Really?
Yes. So Singaporeans tend to be a bit more worried about losses, right? So I think the scenario that I'll give you is, let's say, if I were to tell you, hey, Andrea, you give me $50 today, right? Tomorrow I'll give you $100.
Sure.
As compared to, I tell you, hey, Andrea, you give me $100 today. Tomorrow I'll give you $250.
Okay.
Right. So generally speaking, depending on the psyche of a person, right, most people will say, okay, you know what, I'd rather give the $50 and then I will 2x my money tomorrow. I get back 100. But they don't go one step further to say, hey, but if my capital outlay now is more 100, I actually get back
2.5 times.
Yeah, correct.
Right.
So if you think from that way, clearly the second scenario makes more sense.
Right.
But an investor who is geared more towards loss aversion bias in line with prospect theory, they'll say, no, let's keep my capital outlay a bit less.
Okay, interesting.
Right? So when you actually dollar cost average in to any asset class for that matter, right, it helps you shift your mindset away from the fact that, hey, this investment is losing money into, hey, I'm actually buying it at a cheaper price. Right? So it's
interesting because all this is a mindset thing.
It is. Effectively, you're right. It is. It is a mindset. It is a very emotional, psychological thing.
Okay, so while we're talking about mindsets, right? Here's something that I think is risk averse, because to me, dollar cost averaging just means, I need to keep watching things every month that I put in this money, etc. But I'm of the opinion that putting a lump sum, which is the opposite of a DCA approach, is more risk averse in my opinion, because then you're just putting the money there. I'm like, okay, I don't need to see it. I don't need to check on it for a while. My money's in there. Done. So where do you stand on this? Am I on the right track here?
I am on your side, actually.
Okay.
So I tend to take a bit more of a contrarian approach.
Okay.
But I would say that, statistically speaking, research-wise, the numbers are on our side, on your
Okay.
side. Yeah.
Okay.
So lump sum investing, right, is different from dollar cost averaging, where you dollar cost averaging, as mentioned, you're disciplined. Every month you put the money into an asset class, a long-term investment,
Correct.
and you don't care whether the prices are up or down. If prices are up, then of course you buy less of that
Yes.
of the asset class.
Yes.
If prices are down, then you buy more.
Of course.
Right. But you want to use equal amounts, that's fine as well. Lump sum investing is, when prices are down, you just
Go all in.
go all in.
Yeah.
Right? And I will have you know, and I think you'll be happy to know that not my words. I think any of your listeners and viewers can Google themselves. Lump sum investing statistically has actually outperformed dollar cost averaging over the years.
Indeed.
Yes.
Yeah,
Yeah.
because I was just before you came, I did a bit of research, and there were a couple of guys who were talking about, lump sum versus dollar cost averaging. And they did a comparison chart on a particular stock, I won't say which, on the S&P 500. And lump sum, it was a $6,000 amount. The dollar cost averaging was $500 a month for obviously 12 months. And it turned out that the lump sum yield was higher by almost by over $1,000 compared to DCA. So when does DCA make sense then? Where and when will it make sense? And
So-
I know you're contrarian, I'm bearing that in mind, but we need to be objectively looking at this as well, right?
Yes,
Because there are
yes.
people out there who do believe firmly in DCA.
Correct. I will take a balanced approach on
Sure,
this.
yeah.
I think DCA works when an investor is, as I mentioned, very risk averse.
Sure.
Secondly, when clearly the investor doesn't have the ability to do a lump sum investment. Say if I was fresh out of polytechnic or even in university, right? I would actually think that DCA actually makes more sense.
I see.
Yeah. This unless you tell me that as a poly student, or as a uni student, I strike Toto or 4D, right?
Nice
then
little windfall.
Yes, and then I get a windfall, and then
Yeah.
that's where you get to go lump sum investing. But
Right.
how often does that happen, right?
I know.
Yeah.
It's
So
literally 1 in a million.
correct. So it makes sense to then dollar cost average if you are in that category.
Right.
Right. And I think there's no harm, because whether you dollar cost average, whether you lump sum invest, fact of the matter is, yes, lump sum invest may still outperform dollar cost averaging, but in an investing journey, in a wealth creation, wealth building journey, you're not building anybody's wealth but yourself.
That's true.
Right. So even if you are dollar cost averaging, at least you're getting some sort of returns better than
Better than none.
Yes, exactly.
Better than staying still, I
Correct,
suppose.
correct,
Okay, so let's
correct.
go back to what we were originally wanting to talk about,
Yes.
and that's the asset classes where DCA averaging, dollar cost averaging would make sense. So what would those asset classes be?
Well, I think if we were to if I had to pick, right, using the psyche of a dollar cost averaging investor, DCA kind of person, right, then of course you want to look into the broad-based index. So say maybe for STI, for example, you want to look into the S&P index, for example. Of course, if there are certain thematics in the market that you really strongly believe in, very high conviction, right? So say the rage the past 2 years, 3 years has been AI technology, right? So
Yeah.
I don't know, for our audience, I'm not going to name any stock, right? Because this is
Sure.
not a crystal ball kind of thing, right? But really, it's if you really have full-on conviction that a certain company is going to do well, is leading at the charge in building the AI frontier, pushing new boundaries, then you want to dollar cost average into that as well,
Okay.
right? So that is the kind of asset classes that I would pick.
Okay.
In this day and age, with all that's happening in the markets, especially with all these geopolitical tensions and uncertainty, I think even dollar cost averaging into, say, gold, for example, will
Really?
make sense as well. Yes,
Okay.
yeah, because gold is a nice inflation hedge, right? There is no one country that can say that, hey, I can control the price of gold, stop trading gold, that kind of thing.
Right.
Yeah. So those
Okay.
are some of the things I'll pick.
Right. What about things that are a little bit more adventurous, right? Emerging markets, things that you're really not sure yet if there's a bit of a trajectory, right? Can you dollar cost average those things as well? Because then you're risk averse, but you're kind of like tapping your feet into the market, putting your toes in the market, having a feel of it, and then you can say, I think I'll take it out now. I think I'll pull back now. Is that a psyche that's common?
I think that's a very prudent way of approaching it.
Okay.
Again, then we are letting your viewers and your listeners see that that is the risk-averse side of Andrea that's coming out. You know,
Yes.
which is good because emerging markets, right? Say Thailand,
Yeah.
Indonesia, this sort of things, Malaysia,
Or even small caps. I mean, Singapore
Yes.
is going to have more small cap and mid cap listings very soon.
Correct.
And retail investors especially, are going to start looking into that, right? Because they want to champion their local,
Yes.
winners,
Yes.
their local heroes also, right? So maybe as a first step, is dollar cost averaging something that they could explore?
Definitely, because I'll give you an example, right? My kids love ice cream.
Okay.
Right? You
Oh,
walk in.
which kid doesn't? Show me.
That's true. Yes, that's true. I love ice cream.
Well, we're all big
Yeah.
kids. We'll have ice cream after this. But
Correct.
yes, back to your analogy.
So, if you were to walk into an ice cream shop,
Sure.
right, and there's so many flavors out
Yep.
there, right? What do? What's the first thing that you do?
Sample.
Exactly. So
Yeah.
I would say, I would then reframe dollar cost averaging as sort of like a sampling. Right?
Okay.
Where you think that, hey, maybe this certain mid cap or small cap stock is there's some promise to it, right? So instead of dollar cost averaging, say maybe using your earlier example, $500 every month, right? Why not let's just go with even more, with even less risk, right? Maybe I put like $100
Yeah.
every month, that kind of thing, right? And then I will wait and see over time, over a period of 2 years, and see where that gets me,
Okay.
right? And from that point of view, it actually makes sense to dollar cost average.
Yeah, now I'm feeling like, sampling multiple ice cream flavors may not always be a bad thing, but it's only really if you are up for it, if you want a sense of adventure. A little
Correct.
bit.
Yes,
Okay.
exactly.
So there's a question here about how DCA actually helps investors address concerns about market timing. Now, I know that the age-old advice is time in the market and not timing the market, but how does DCA sit with that?
Very good question. DCA definitely sits very well with that the adage that you just pointed out, that time in the market is better than timing the market, right? I will say that for general investors, time in the market definitely makes sense, right? DCA will actually be a very good way to erase the fear, or rather at least calm the anxiety that, hey, markets are selling off.
Yeah.
So an example, rewind time a bit, we are back to, say, the bear market of 2022,
Yes.
right? So for a person that has been dollar cost averaging down, right, you would actually have the mindset to tell yourself that, hey, I am not timing the market, right? I am actually in this for the long run.
Yes.
Right. So I'm holding with a 5 to 10 year horizon.
And that's where the discipline comes in.
Exactly. So the discipline then comes in, right? I'm just going to throw a spanner in the works here,
Sure.
and also say that I'm not ignoring the investors that do lump sum investing.
Sure, yeah.
I think there has to be a certain factor where we time the markets.
Sure, yes. I wanted to ask you about that, yeah.
Yeah. So I hope I'm not getting ahead of myself.
No, please go for it, yeah.
But if using the same 2022 as a 2022 bear market as the same example,
Sure.
for a lump sum investor, right? If you were to invest lump sum into the markets, now nobody has a crystal ball. Nobody is able to predict when the markets actually really bottom out. Right, I know maybe there are some financial gurus out there who can do that. Good for them. But let's use technical yardstick
Okay.
to make very rational decisions, right? So, assuming that I'm a lump sum investor,
Sure.
okay, and a bear market is when an index has fallen at least 20% from its peak,
Okay.
right? So, if I were a lump sum investor, I would actually time the market in a sense that I will wait for the first drop, 20%,
Okay.
right? And then I will put a lump sum in,
Got it.
right? And then it drops further again,
Yeah.
right? So another 20%, I'll put another 20% in. So it seems a bit like dollar cost averaging, but the
Yes.
difference is that instead of being very doing this on a monthly basis, very disciplined manner, I'm really waiting for that 20% drop.
Right. Because you want to maximize your buy-in, right?
Correct. So I actually went to do my own study and just yesterday while preparing for the interview, I said, I want to make sure I get my numbers correct.
Sure.
Right. So I went to simulate that if I were to lump sum invest every 20% drop, right? I would actually, instead of waiting to 2024 to break even,
Right.
by May 2023, I would already have been profitable.
Oh, okay.
Yes.
Because you've bought in at the dips.
Yes.
At the various dips and then
Correct.
waited for it to climb because
Correct.
the climb is what matters.
Exactly. Correct. So by May 2023, the second and third round of buying after a 20% drop, right, actually helped cover the losses for the first 20% drop.
I see. Okay, I understand that now. And I understand why this is kind of timing the market, but you're still having that long-term goal in mind because you're thinking about how much your input is going to grow once it passes the bear market.
Exactly.
Okay,
Correct.
understood. Okay. So, if I've just received my bonus and I have this windfall, maybe I'm cashing out on a ILP, for example. I have this windfall. What would you recommend? What do I do? Do I go with the lump sum straight away, or do I DCA it, or do I do a hybrid?
Very, very good questions. I think it also boils down to the financial safety net that you have.
Yes.
So I'm going to go out on a limb here and assume that you've necessarily covered yourself with the right insurance coverage.
That's right, yeah.
You already have 3 to 6 months of liquid cash lying around
Yep,
in the
emergency
event.
fund.
Yes, exactly, emergency fund. Right. Then I will say, okay, over here that I would actually take a bigger chunk of the windfall or the bonus, right, and then do lump sum investing.
Okay.
Right? Because if assuming that you have a long-term horizon of long-term investment horizon, 10 years or so, statistically it's been proven that no matter where you invest in the market, as long as you hold on to your investment, you will start becoming profitable by the 11th year. Right? So lump sum investing statistically outperforms dollar cost average. So this is how I will do it. I'll take a chunk,
Okay.
lump sum invest. The remainder, right, I will dollar cost average to sort of diversify away into other asset classes or other things. So that is me taking care of my investments. And I think in this day and age, mental health is an important thing. I would go the extra mile and take a bit of money, enjoy it,
Yeah.
buy ice cream or, maybe treat my friends, my parents
Sure.
to something nice.
Of course.
Yeah.
Good,
So
good advice. Good advice.
That's how I will actually play it.
Okay,
Yeah.
well, the windfall is coming at the end of the year for many people, so that will be very handy advice. Any common mistakes that people make with dollar cost averaging that you've noticed?
Yes, I think first and foremost, the example that I shared with you earlier is that because of the makeup, the psyche of a dollar cost averaging investor, an investor that DCAs, they tend to want to hurry cash out their profits, right? So don't be such a quick hurry to cash out your profits. I think it's important to pay yourself, right? Nobody works for 10 years and then you don't pay yourself, right?
Yeah.
So I think just as we dollar cost average to build our wealth, to invest, I think over time we need to learn to cash out and pay ourselves. Of course, you don't cash out everything. You want to take some and then reinvest it as well.
Yes.
But paying yourself helps build the sort of discipline as well that, hey, this DCA strategy is working and I'm going to stick to it regardless.
Yeah.
So that is one tip and one pitfall that I think investors should avoid. The second one will be, in the pursuit of trying to avoid chasing the markets when the markets are trending higher.
Yes.
Right? Because humans tend to be very greedy, right?
Of course.
So when you see that markets are trending higher, there's always that urge to say, hey, I've been dollar cost averaging, and since it's going higher, markets for example, the S&P has just shaped a new historical high.
Yeah.
Why don't I put more money this time? Don't do that. Right?
Okay.
The whole idea of why you dollar cost average in the first place is because you want to build that discipline.
Yes.
Right? So don't be so quick to chase after the latest fad, the latest fashion. I think it would be very detrimental to the overall part of the investing
I mean, I
strategy.
guess only do it or only increase your holdings if you feel you're comfortable sustaining it for the long period, right? Because ultimately, as you've repeatedly pointed out, the recurring theme here is discipline, fiscal discipline, right? And I'm sure that listeners and viewers watching this will find this very valuable as well, because I think a lot of people are at the crossroads, just like me, deciding, okay, am I a long-term lump sum gal or am I a DCA person? And it really depends on your character and your personality at the end of the day, and your financial capacity to do so.
Exactly.
All right. Thanks very much for sitting here and explaining all of this to us. Really appreciate it.
My pleasure, Andrea. Thank you for having me here again.
The pleasure is all ours. Thank you so much once again. And for you listening, if you've got any comments or messages for myself as well as for Isaac, you can always drop us a message and we'll have them answered. Money Talks is available on Apple Podcasts, Spotify, YouTube, and Me Listen as well. Please don't forget to rate us if you like us. Big thanks to the team, Tiffany Ang, Nat Fetalvero, Junaini Johari, Joanne Chan, Hanida Amin, Saya Wind. This is the Money Talks podcast. I'm Andrea Heng.